Hello and good morning, listeners. Welcome back to Almus Market Mornings, your morning brew of global financial update with Jayaram Krishnamurthy. Now, folks, yesterday we had the US PPI data, which further affirmed the case for Fed to go ahead with the rate cut. On the other hand, China's factory deflation eases, but the CPI inflation is also seen below zero again. And on the contrary, on the metals market, it is interesting to see the borrowing cost for silver in this rally has been rising above the 5% mark several times, which is well below the historical levels, suggesting the kind of demand which is persisting for the metal. Now, JK, how do you see these developments and what should one be expecting out of the inflation data today?
Good morning, Shikhar. Yeah, PPA was softer than expected, but I think we have to read this month's number along with last month's number. And last month we had seen a big beat. It came at 0.9% month on month versus 0.3%. And this month, of course, it's slightly lower than the expectation across. Averaging out overall, the PPA number has been stronger. uh, there could have been monthly differences in the weightage for prices. Some prices would have gone up the previous month much more than this month. That is where that is how it is read. That said, I don't think it changes any expectation from the Fed about a rate cut this month. Eyes will be more on the CPI number that will be published today, where the headline is expected to inch up to 2.9% from 2.7%. And the core is expected to remain steady at 3.1%. So again, if these numbers come as expected, it doesn't change expectation from the Fed. If it comes slightly stronger also, I still think Fed will go ahead with the 0.25% because their focus is more on the jobs market right now, which is clearly showing very deteriorating situation. But if it does come softer than expectation, then probabilities of 50 basis point cut can go up in some opinions. So it is a very important number as far as the Fed rate decision is concerned. And yeah, there will be a cut, but whether it will be followed by a series of rate cuts or whether it will be on the extreme 50 basis point cut this meeting is something that we are going to assess. Yes, Trump did not lose time in pointing out that right now Fed has to cut the rates large, and that is to be expected from Trump, of course. Yesterday, also the geopolitical tensions took center stage. Of course, you also mentioned about the Israeli attack in Doha, targeting some of the Hamas leaders. Then we have also had some tensions in the Euro region when Poland shot down some drones over its airspace, possibly the Russian drones, Russian missiles. So that also created some sort of a tension in the European region and kept the euro's gains in check. Euro was finding continuously some profit taking at higher levels and stayed around 1.17 region. Of course, we also have the ECB meeting tonight, where they are expected to hold the rate steady. Once again, their forward guidance will take more focus, and possibly, they will keep door open either way, because now that inflation is on the mend due to the lower oil price sustaining. And so I think ECB will keep their options open, but there are members in ECB who are actually saying that rates should not go down further. This is more because there will be more fiscal spending from Europe as well in the in the coming days. Just possibly it has become a routine to say that S&P 500 and Nasdaq have hit a new all-time high once again. And yesterday the trigger came from Oracle. and the biggest one-day percentage rise for the stock since 1992 after they made a late entry into the AI and huge demand surge for their AI products, and the stock surged as much as 39% at one point of time. So that was the news in the stock market. As far as the dollar is concerned, it was very much range bound. Possibly, ahead of FOMC, we don't see much of an action in the major currencies. For the rupee, again, the ranges are narrowing down much more. Now we are actually between 88 and 88.20. Market may be probably looking at the fact that we are actually seeing the 1 year forward rate, which is above 90 now, and that could be attracting some exporters. When I talk to some people, they are in two minds whether they should hedge some at these levels, in despite the uncertainties. So now that we know what the huge uncertainties of the trade tariff, being high, and possibly now, if there is some positive progress, we can see a sudden drop in the rate. So I would think that some partial hedges of long term should be taken by the exporters at 90 plus. So even if there is a higher move from these levels, it may be contained by RBI because rupee is already fair valued, perhaps less than fairly valued. And since our view on the dollar index is weaker for the medium term, rupee will not be allowed to weaken too much. And so I know one more factor that is coming to play is that if FI holding in Indian stocks is at multi-year high, multi-year low, sorry, and with growth prospects, incidentally, Fitch has upgraded India's growth outlook for FY26 from 6.5 to 6.9%. So with growth outlook good, and India possibly over a period tide over the difficulties out of trade tariff. I think it may not be too long before FIs return, and US rate cuts also could spur more investments into India, more money flow into EMs in general as well. So all these things, I feel a bit of long-term hedge by the exporters for 1 year forward is justified. Not a whole lot of hedges, but some hedges is very likely. At the same time, importers also remain a bit cautious because spot is trading at the highs and premium cost is much higher now at 2.3% for 1 year. So all in all, slight bias towards more dollar selling against INR. That is where I'm looking at. Thank you.
Okay, JK, that was really good. And yes, folks, we have started seeing some bit of attention rising for the 1 year hedging actions by the exporters. And as JK mentioned, it is recommended to start or at least consider partial hedging of the exports with the fair value of rupee under consideration and the record lows of the FII participation, along with the change in the or rather upgrade in the growth outlook by the Fitch. Now, these are certain factors which may turn out to be positive, apart from the political and trade related factors which has kept the rupee under stress. As of now, the movement has been quite narrow in its range. But on the global side, if we see the PPI being softer than expected and still on the stronger side while we average, the eyes are still keen to watch as to what inflation updates are we going to see today, and the headline numbers are expected to inch up a little while the core to remain stable. If we have any sort of softer inflation update, this can probably add to the quantum of rate cuts expected. Otherwise, the current expectation of 25 basis points prevail. We also have the ECB meeting, which is expected to keep the rates on hold. But the update which was most surprising yesterday was the biggest one-day rally by Oracle on the backdrop of the AI-related activities. It's also to be noticed that technology stocks now reflect 37% of the total US stock market. This is just something interestingly different, and we are now exceeding the levels last seen during the dot-com bubble of 2000. The share of tech stocks have doubled in just 5 years. So these kind of market concentrations can also be seen in the financial markets as of now. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for joining in.